Today feels like it's been a long time coming here in the UK, ever since former Chancellor Kwasi Kwarteng announced that mini budget causing turmoil in financial markets. The UK has been the talk of the town. The pound has been extremely volatile. Borrowing costs have risen considerably, although they have now since pared back. And the question on everyone's lip has been, what's going to happen to the UK economy? Are they heading for a recession? How deep is the recession going to be, and how long is it going to last? And a lot of those questions were not going to be answered until we got new answers on the government's spending and tax plans. And we had to wait longer than we hoped. What was brought forward was since pushed back in the aftermath of that turmoil, and with the announcement of a new government and a new Chancellor, Jeremy Hunt, who delivered the autumn statement today. And it seemed that there was a huge fiscal black hole to fill that was going to be filled by both spending cuts and tax increases. The makeup of that was going to determine just how severe the situation was going to be and whether the UK government could regain any fiscal credibility after such a difficult period. And on the face of it, in the immediate aftermath of that autumn statement, it seems that it's been relatively well received by the markets. I should stress that a lot of this typically gets leaked in the days leading up to the announcement itself. So you tend to get very few surprises during the actual autumn statement itself. But the balance of tax cuts and spending increases and the way in which it's been spread appears to have been relatively well received by the markets. If we look at the pound, for example, we saw that very volatile throughout the session, but roughly ending where it started the statement itself. You look at borrowing costs, and they came down marginally during the statement itself. Interest rate expectations from Bank of England as well. We saw slightly pared back. It seems that the markets now expect the base rate to peak at around 4.5%, ever so slightly lower than where it was prior to the autumn statement, and much lower than where it was after the mini budget, and lower than where it's been in recent weeks. Obviously, that works in unison with the warnings from the Bank of England that the markets were ahead of themselves, that the central bank does not anticipate interest rates to rise as high as what the markets currently anticipate. And obviously the vote, which coincided with that from policymakers at the last meeting when rates rose by 75 basis points, but one voted for 25 and another for 50, showing that there is that slight downward bias within certain quarters of the Monetary Policy Committee. But the important thing was always going to be this autumn statement and whether it was going to be well received. And the initial reaction has been relatively positive. Of course, for the next days and hours, we're going to see people pore over the details of these spending cuts and see how harmful they could potentially be, pore over the details of the tax hikes and see how impactful they will be on the economy. But there was a lot to unpack within that autumn statement. And the best that we can do right now is take a look at the markets and see what that reaction was. So here is a pound dollar chart, otherwise known as cable, of course, and it's on a daily basis. And as you can see from this, the pound is down ever so slightly on the day against the US dollar. But I should stress that the US dollar is up around 2/3 of 1% against a broader basket of currencies. So the moves that we're seeing in the pound dollar largely reflect the dollar strength, which we are seeing in financial markets as a whole. It's trading around 118 at the point of recording. Going into the budget announcement itself, it was trading around 118.50. So we've seen a slight pullback in the pound against the US dollar during that time. We can't really attribute that entirely to what was announced within the autumn statement. And it's such a small move that even if we were to, it would represent such a small move that we don't really want to read too much into moves of that kind. When you look at how the pound has performed against the US dollar more broadly in recent weeks, it has been more positive, and that is a reflection of that improved fiscal credibility in the aftermath of the Kwarteng mini budget and the measures which have been announced since, reversal of certain measures that were announced in that mini budget, and then the imposition of a new government and the leaks which we obviously had in the days running up to that autumn statement all factor in to the rebound that we see in the pound. But also the dollar itself has corrected quite significantly in that time, alongside much improved sentiment in the markets in the aftermath of the Fed meeting a couple of weeks ago. The jobs report that we saw on that Friday, we saw a sharp rebound lower in the US dollar in the aftermath of that. And then the CPI data, which followed, which was much better than expected, and the PPI data, which followed a week later, which really backed up that trend that we saw in the CPI figures, giving people increased confidence that we could see a longer term improvement in the inflation data, allowing the Fed to also move at a slower pace. So all of these things factor into what we see in the pound dollar pair. In terms of what's next, there's some really interesting levels which I think are on this chart, which I think we're going to be keeping a very close eye on. The first thing to note is the rally, the recovery has stalled around 120. Not an enormous surprise. Big round numbers typically have that impact. The fact that it coincides with the 50 fib that you can see on the chart here, I think is also an interesting point as well. Also roughly around the bottom part of that descending channel. We seem to be seeing a bit of a pullback from that 120 level, like say towards 118 where we are now. If that's going to be part of a broader corrective move, then I've added another fib retracement zone on there from the lows that we saw in September through to the peak a couple of days ago. If we are seeing a broader retracement, then I think those fib levels are going to be interesting. So around 114 and also 112, and then again 110. That's the 38.2, 50, and 61.8 fibs. The first of which actually falls around the bottom of that 55-89 day simple moving average band. So that's going to be the first level of significant interest should the pair pull back that far. But broadly speaking, it does seem that we are seeing a bit of improvement in risk appetite. It does seem that we're seeing an improvement in expectations on inflation, and that could potentially come to the benefits of other currencies against the US dollar, including the pound, with this hopefully newfound fiscal credibility and hopefully an improved path for economic growth and inflation going forward. Of course, we'll get plenty of assessments of that over the coming days and weeks and months. But if we do see a continued move higher through 120, then the next extend that level here for me is around 124.50. This is where the top of the 200-233 day simple moving average band coincides with the 61.8 fib of that initial Fibonacci retracement level, which we highlighted earlier on in the video. It's also around the midpoint of that initial descending channel, which we broke free of before as well. So I think there's some really interesting levels coming up. I think there's going to be plenty more volatility in these currency pairs. Everyone is now data dependent, and therefore we could get plenty of shocks and upside surprises along the way as we see things unfold going into those crucial December end of year meetings for various central banks around the world, including, of course, the Federal Reserve and the Bank of England.